You are smart. You know it. Your grades proved it. Your career proved it. And when you discovered trading, you assumed that would prove it too. It didn't. The reason why has nothing to do with the market. It has everything to do with what intelligence does to a person when they sit in front of a chart. Here is what nobody prepares you for. Intelligence is a weapon built for a specific kind of problem. Problems with clear rules. Problems with right and wrong answers. Problems where more thinking produces better outcomes. Trading is not that kind of problem. In school, the harder you thought, the better you did. Effort and intelligence were directly rewarded. Your brain learned one lesson across years of education. Think harder, win more. And then you opened a trading account, and your brain did exactly what it was trained to do. It thought harder, found patterns, built theories, constructed reasons for every trade. And the market ignored all of it, because the market does not reward thinking. It rewards probability management. And those two things are almost opposites. Psychologists who study expert performance found something deeply uncomfortable. In most fields, expertise leads to better outcomes. Doctors, engineers, architects. The more they know, the better they perform. But in uncertain environments with random feedback, expertise can actually make performance worse. They call this the paradox of expertise. The more you know, the more patterns you see. And the more patterns you see, the more confident you become in patterns that aren't really there. A beginner looks at a chart and sees noise. An intelligent trader looks at the same chart and sees a head and shoulders pattern, a Fibonacci retracement, a supply zone, a liquidity grab, and 3 separate reasons to enter. The beginner does nothing. The experienced trader enters and loses because they saw too much. There is a second problem intelligence creates in trading: post-trade rationalization. After a losing trade, an intelligent person does not accept randomness. Their brain finds a reason. The news caused it. The setup was almost perfect, just slightly mistimed. They build a story, a convincing one, because intelligent people are very good at building convincing stories. And every convincing story keeps them from seeing the actual problem, which is that the loss may have simply been random. And random losses have no lesson. They just happened. Accepting that is one of the hardest things an intelligent person can do, because intelligence resists randomness. It insists on meaning. It demands explanation. And markets are full of meaningless noise that intelligent brains are desperate to decode. But there is a third problem, the most dangerous of all. Intelligent people overtrade, not because they are greedy, because they are bored. A disciplined system requires you to wait, sometimes hours, sometimes days, for one specific setup, and then do nothing until that setup appears. For an intelligent, active mind, this is almost unbearable, so they find reasons to trade. Adjust criteria. Tell themselves the setup is close enough. They convince themselves their analysis is better than their rules. And they enter, not because the setup was there, because the waiting was uncomfortable. Researchers studying self-control found that people with higher cognitive ability are more vulnerable to this exact pattern, because higher intelligence means a higher ability to construct convincing justifications. And a convincing justification feels exactly like a real reason. Your brain cannot tell the difference between a genuine edge and a sophisticated excuse. This is what makes overtrading impossible to stop. It never feels like overtrading. It always feels like a calculated decision. So what separates traders who survive? First, they accept the market is partly random, not chaotic, partly random. Any single trade tells them very little. They measure performance over hundreds of trades. Second, they follow rules they cannot argue with in the moment, not guidelines. Specific, written, non-negotiable rules. Because they know their intelligent brain will find a reason to break any flexible rule, so they make the rules inflexible. Third, they become deeply suspicious of their own reasoning. When they find themselves building a long explanation for why this trade is different, they stop, because a long explanation is almost always a warning sign. A genuine edge does not require explanation. It is either there or it isn't. The market does not care how smart you are. It does not reward cleverness. It does not punish stupidity. It moves according to millions of participants, most of whom are also trying to be clever. In a game where everyone is trying to be clever, the edge belongs to the one who stops trying. Intelligence brought you to trading. Discipline will keep you here. And the moment you stop trying to think your way to profit is the moment the market finally has something real to teach you.